Yeah. So till yesterday, we have seen many reforms being taken, and one among them is LPG, liberalization, globalization, and privatization. Right? We have completed liberalization and privatization. Now, today, we shall see globalization. What actually it is. See, it is the integration of one economy with the economies of the rest of the world so as to make it look like a global village. See, we're not telling global city, also, we are saying global village. Why? Because we have integrated with other economies as one economy. Okay, integration of one economy with economies of rest of the world. Okay, now what we are doing by this, we are removing all the barriers on what, on the movements of goods, services, both physical resources and financial resources, technologies, etc. Okay, between one country and the other countries of the world. So, simply in simple words, what we can say is free flow of goods and services across the world. We call it as globalization. Okay. See, why no? There were barriers in foreign trade in previous years. No, getting goods from, no, importing raw materials or finished goods, exporting raw materials. No, there were some barriers, especially, you need not send your raw materials to one country or some other country like that, but these barriers, they are totally removed. Okay, the movement is now very free, services are free, physical resources free, yeah, free movement, financial, foreign direct investment policies and all. So financial movement also is very free. Okay, free movement is a technology also is moving very freely in one country and other countries. So this is what is globalization. See, government policies towards globalization. See, as I told you, there was many restrictions in doing business in India, especially high tariffs, high tariffs on imports and exports. Quantitative controls also. Only you have to send this much only to this country, like that. So quantitative controls were there, and the free conversion of foreign exchange also. So you can say that there was a closed economic policy was devised. Why? Because, no, especially to protect our industry, that is domestic industry, services sector, including financial services, and to conserve and use limited foreign exchange reserves to meet the essential requirements of food and materials. For that reason, no, high tariffs and many restrictions were put. To overcome this, no, government of India, they have approached International Monetary Fund and World Bank for assistance. So that the result of this is 1991 policy, which has given us following measures. Okay, one is especially towards globalization, and these measures are, see, import liberalization, right? See, government of India, what they have done, they have permitted import of especially capital goods, intermediate goods, and raw material. Okay, except the restricted imports, the peak rate of customs duty on non-agricultural products has been brought down from its 150% in 1991 to 40%. Okay. So this all what the government of India is doing is they are removing all quantitative restrictions. Okay. They started from April 1st, 2001 onwards. So this measure, what it has done, it has liberalized imports and exports. Okay, number one. Number two is foreign investment policy. This FDI and FFIs, that is foreign investment institutions, they have been drastically altered and changed, especially, from 1991 onwards. So the government, they permitted no, to open it, or they have opened up, you can say, floodgates for the free flow of foreign investments in the country. Yeah. See, when more money is coming, then there's a possibility of manufacturing more goods and providing good services, qualitative services, and all these things, right? So, free flow of foreign investments on a large scale has come, no, because of this investment policy. Foreign technology and technical know-how imports were also permitted liberally, because no royalty payments, they are being regulated by RBI of our country. So much liberty is given to free flow of foreign money into our country. Okay, and the third one is exchange controls. Hmm. Yeah. Third one is exchange control. See, this India, no, what it has done is adopted foreign exchange rate policy and strict exchange controls for long. But the because of this Foreign Exchange Regulation Act, which was passed in 1973, it has been replaced by FEMA in 2000. So that is Foreign Exchange Management Act. So majority of restrictions, right, in the form of exchange controls, they were all diluted, they were changed, they were altered. Then next is devaluation of rupee. See, the financial and foreign exchange crisis was the main driving force, we can say, to make India to take no corrective measures so that they can control the rupee value of our country in foreign market. Okay, so they they have taken up many things, like they devised twice in effective devaluations, and especially to they started boosting exports and discouraging imports. Okay, so this is how they can devaluate the rupee. Next is liberalized exchange rate management system. Okay, LERMS or LERMS, liberalized exchange rate management system. This system, no, it introduced dual exchange rates. Okay, two dual exchange rates to give an incentive to earn a larger amount of rupee earnings to the exporters and recipients of foreign exchange. Okay, so dual, to give an incentive to earn a large amount of rupees earnings to the exporters and recipients of foreign exchange. So under this, no, 40% of the export earnings are converted into rupee at the official exchange rate, and the remaining, no, 60% at the market exchange rate. So these are the two methods. One is, no, they were just converting that rupee at the official, what the government decides, and all official exchange rate they were converting, and the other 60% at market exchange rate. Okay. Next is full convertibility. See, this no LERMS, no, this has been replaced with a full convertibility of the rupee that can be converted. See, any foreign exchange and all that can be easily converted into Indian currency, and Indian currency into foreign currency. Now, at what rate? At a predetermined exchange rates. Okay, and these exchange rates totally depend upon demand and supply of rupee amounts. Okay, without any government permissions. So that is what is full convertibility. Next, we'll move to. So before that, no, we have seen privatization, liberalization, and globalization. So let us now see what is the impact of all this LPG on Indian economy, especially. Okay, see, number one, the rate of economic growth that has been, in leaps and bounds, that has increased. Especially, in the eighth plan, GDP growth rate was 6 to 8%. Okay, so a lot of growth is being seen after this LPG is introduced. Then second one is industrial growth. Industrial sector, which was lacking, no, the past 2 decades, now they have boosted up. Okay, from 8% to around 30%. Okay, there's a very big shift in from basic goods production to no high end goods and services. The country started manufacturing number of capital goods. With that capital goods, they can manufacture some other products and services, right? And durable goods manufacturing of consumer goods also have increased, right? So a lot of changes have come after LPG is introduced. So rate of economic growth, yeah, yes. So infrastructure, they have developed many projects, many power projects, ports, airports, good railway system, no, all these things were built. Then exports, there's a growth in exports also because the restrictions on imports and exports have been liberalized. Then balance of payments during post liberalization scenario, they were quickly made the position of BOP has been changed, right? And inflation rate to a major extent, we can say we have reduced. Okay, researchers, they have documented that price impact of LPG was there, but there is no uh, unanimity of opinion, because even now also we see that prices are going high and high and high, and richer becoming richer and richest, isn't it? And poorer and all. So like that, then employment also has increased, but there is a negative growth rate in employment after LPG program because technology is replaced the manual labor. So we can see employment unemployment being created by LPG, and to some extent, okay. And poverty is there. Yes, unfortunately, we fail to reduce this poverty levels in the country. So these are all the impact of LPG. Yeah. Next, we'll see Indian financial system and reforms in financial sector. Okay. See, very important function of finance manager is to provide the firm with the required funds from various sources at an acceptable cost. Yeah. For this purpose, now what he does, he deals with financial institutions, he deals with financial markets, he deals with financial instruments. Okay. And likewise, okay. These form of the component of financial system, they will, what they do is they try to build or establish a bridge between savers and the investors. Okay. The savings of the former income groups are providing us funds to the income groups for what? For specially for consumption, okay, and for investments, right? So what the financial system does is it is not only encouraging savings and investments, but it is also no efficiently allocating resources in different investment channels. right? And when they are doing all these things, definitely the rate of economic development would be increasing, isn't it? So Indian financial system, these are characterized by financial repression in 1991, okay, and uh, they have been reformed, especially with some goals, with some objectives. Number one is to improve operational efficiency. Number two is viability, and number three is profitability of financial intermediaries. Now, how they will do it? By removing financial repression, okay, and infusing competition, strengthening the balance sheets by imposing minimum capital requirements, and provisioning requirement of assets, enforcing better on-site and off-site supervision, and widening and deepening the financial markets by introducing new instruments, increasing the number of participants, and strengthening the trading and settlement mechanism. So, in just what in a simplest way, what we can say is financial system, they are encouraging savings, they are encouraging investments, they are encouraging uh, how to allocate these resources efficiently, and uh, uh, what we can say is making a very good platform for investment channels, all these things to accelerate, yeah, to speed up the economic development in our country. Okay.
It's like opening a business market.
Yeah. Yeah. Yes. 1 minute. Okay. So, see, I'll just read out this whole thing from the slide so that you can again easily understand what is financial system. See, a system that enables the exchange of funds or financial services, savings and investments and all, between suppliers of funds, that is money, and the borrowers is called financial system. See, there must be some suppliers, okay, especially of money. If they get the money, the business entities can grow, isn't it? So, and there are borrowers, and when you are making them come to one platform and making it very smoother, right, in interest rate or whatever it is, in this, then it is financial system, isn't it? In the process of exchange or transference of funds, there can be many players such as investors, agents, borrowers, institutions, and instruments. Okay, so all these together, no, we call it as financial system. See, remember, suppliers of money and borrowers, right? They are there in the market, and some institutions, they would be providing, some agents or some borrowers, yeah, they would be providing all these things so that production and exchange of goods and services take place easily. Okay, this we call it as financial system. Yeah, what are the constituents of financial system? Number one is financial institutions. Right. See, these are undertakings, or you can say establishments. What they do, they transact in money, what in the form of mobilizing savings and lending them to the needy. And that needy can be consumers or investors. Why they are doing it? To gain. Okay. So the financial institutions, they are again classified into banking and non-banking companies, investment banks and development banks, insurance companies are also uh, comes under the financial institutions. Okay, and non-bank financial intermediaries like we have in India, chit funds and indigenous bankers, money lenders, and all, they all come under this. So they bring investors and borrowers together. Financial institutions, what they are doing, they are bringing both borrowers and investors together so that they can mobilize resources directly or indirectly. Okay, through a number of financial instruments like banks, development financial institutions, all these things what I said. So this is what is financial institution is one constituent or one body or one organ we can say. And the second one is financial markets. See, we have two markets, that is money market and capital market. So money market short term and capital market long term. Okay. So money markets, they transact in short term claims against money. While these capital markets, as I told you, they claims against money for a longer term, right? Yeah. Another way we can classify financial markets as financial markets as no primary markets and secondary markets. The primary markets, what they do, they transact in new issues of stocks, while secondary market they transact in the stocks of already existing companies. Okay, this is how we can classify financial markets. One way is money market and capital market. Second one is primary market and secondary market. And other one, as I told you in my previous classes also, organized sector or organized financial market or unorganized sector. Okay, organized sector, they all include banking institutions, whereas this unorganized, we have chit funds, we have money lenders and all. Okay, next is financial instruments. See, important concept this is one, and these instruments may be short term or sometimes it may be long terms, especially bills of exchange, treasury bills, commercial papers, right? Shares, bonds, debentures, long term duration, all these things. And the size and the quantum of these instruments, they again depend upon nature of funds required by that particular company, okay, or particular player, okay, in the financial markets. And the last one is financial services. These are provided by number of agents, okay, or provided by agencies operating in financial markets. And these agencies, they are commercial banks, investment banks, insurance companies, acceptance houses, discount houses, credit guarantee houses, credit rating agencies, leasing companies, mutual fund houses, merchant bankers, portfolio managers. These are all okay. They deliver financial services. Okay, this is yeah. Financial institutions, what they are doing, they are bringing investors and borrowers together to mobilize no and mobilize resources directly or indirectly through a number of financial instruments. These financial institutions, they are categorized as regulatory, yeah, intermediaries and non-intermediaries. Okay. The regulatory institutions are, RBI, SEBI, IRDA, and all. Intermediaries, they are banks and non-banking institutions, and non-intermediaries, they are insurance companies, mutual funds, etc. Okay. Next, we'll move to banking institutions. See, the apex bank in our country is RBI, isn't it? Reserve Bank of India. See, every country they have one central bank which is apex, and it is one no which acts as the leader of the money market. In India we have RBI. uh, it has been established as a private sector in 1934, but it is nationalized in the year 1949. Now, what it does, what are the main functions of this central bank is issuing uniform currency. See, a Kashmiri or a Kanyakumari person or a Gujarati or anybody, we are using Indian rupee, isn't it? So, issuing uniform currency, and it is a banker to government also, and it's a banker's bank. Even it lends some money if they need other banks, then they will lend to the bank also. So banker's bank, lender of last resort, and it is the controller of credit. So these are the main functions of central bank. It is through this what central bank is doing is they are regulating demand and supply of money, and credit through quantitative and qualitative or selective credit control instruments. So the central government, it is regulating the whole financial sector. How? Way of permits, by way of licensing, by way of giving directions, okay, directives. So in other words, we can say RBI is an autonomous body having full powers to regulate the financial sector. Okay. Next is commercial banks. Now this we can call as nucleus of money market. Okay. Central bank is the banks are the nucleus of money market, we can say, because they are connecting bridge. They are connecting bridge between savers and investors. They are mobilizing the dormant savings, we can say, from the hands of public. How through current accounts, through savings, no, savings accounts, and time and cumulative deposits. And by after collecting all these things, what they do is they channelize them into the hands of investors. Okay, in way of short-term loans or long-term loans or medium-term loans. Okay, this is how they are regulating. So that's why they are they have occupied, this commercial banks, they have occupied an important place, and they are acting as survivors or purveyors, we can say, of money, uh, because they have the ability to control the credit also, and the liquidity and money supply in the country especially depends upon the ability of commercial banks to multiply the credit. Okay, this is one. We can, in other words, also say is commercial banks, they are acting as agents to the customers, agents of their customers also, and they perform several financial services like discounting bills, and money transfers, payment of subscription, taxes, and all. Right. So bank accounts, if you have done, you can understand this in your undergraduate program if you have done. Okay. So this is one. Next, we'll move to cooperative banks. See, they especially dominate rural credit structure, especially rural villages. They have some savings, some investment they want to do. No, so credit structure of rural India is being regulated by this cooperative banks. These cooperative banks, the credit delivery system is recognized back in 1912, and it is carrying out. And this again, capital structure of cooperative we can divide into long term and short term credit structure. Okay. The organization of short term credit structure again is three tier. One is apex state cooperative banks would be there, then central cooperative banks at the district level, and primary cooperative societies at the village level. Okay. With long-term cooperative credit structure, we have two tiers. One is state land development banks and at state level, and central land banks at the district level. So the main aim is to pool up the savings of rural villagers and rurals and develop that area. Okay, so that's the main intention. Then at state level also they do. As a consequence, no multi-agency approach to rural credit has come, involving no more agencies into area of rural credit. Next is regional rural banks. We call it as RRBs. Regional rural banks, they were established in 1975, right? And main function, they are very much similar to commercial banks. Okay, except in one or two matters, they cater to the needs of agricultural sector, micro and small manufacturing units, and they take care of the rural development needs, the road construction, connectivity, all these things. The and there are around 196 RRBs in India. Next, we have private sector banks. See, these private sector banks, you can say, are doing a great job. We can say, no, we have a private bank account and all. We need not wait for our say no, or for deposit and all. Online they have developed, right? Role we can say of fostering the economic development of our several private banking systems working almost they work as commercial banks, right? Next is local area banks. Local area banks, the name itself is saying that they are very small banks and they are confined to a small area, limited area, and their operations are also very much limited. And you can say it is confined to one or two districts, we can say, okay. And they operate under the control of any bank in India. They work under the control of RBI only, and the paid up capital of this land area banks would always be maximum 5 crores and minimum it may be 2 crores. Okay. Now, why this local area banks are established is number one to enable the mobilization of rural savings by local institutions only, because they don't come, they want to open a account. In previous days they used to come to the district headquarters and there they have to open. Now things are at the rural area, at the local area only, right? uh, and make them available to investments in local areas. So the overall idea of this local area banks is no, to bridge the gaps in the credit availability, especially in rural and semi-urban areas, by strengthening institutional credit mechanism. So at present we have five functioning labs in the country. Okay. Next is foreign banks. So name itself is saying if it is incorporated or established outside India, it is foreign bank, and they may have their head office in any foreign country, and they are allowed to set any subsidiary also in our country. So at present we have 46 foreign banks, and they are discharging the same functions as what the commercial banks are doing, and again they are being guided by and controlled by RBI in our country. Okay. Next, we have non-banking institution. See, how we have to define this non-banking institution is they made an amendment in 1997, RBI, and they have given this definition. What it is, number one, it's a financial institution which is a company. So you know what is a company. You in business law you might have learned. No, it's an artificial person registered in the company. So likewise, this non-banking institution is a financial institution. Number two is a non-banking institution which is a company and which has its principal business. What it is, the receiving of deposits under any scheme or arrangement or in any other manner or leading in any manner, right? So they are dealing with business of deposits and lending, right? Number three is such other non-banking institution or class of such institution as the bank may, with the previous approval of the central government, specify. So if any changes, amendments have to brought, they have to again take the permission from the central government. Okay. So non-banking financial companies therefore consist mainly of finance companies which carry on hire purchase finance, housing finance, investment, loan, equipment, leasing or mutual benefit financial companies, but do not include insurance companies or stock exchanges or stock broking companies. So other than these three, insurance company, insurance companies, stock exchanges, and stockbroking companies. The other things they do is non-banking institutions. Okay. We have non-banking financial companies. There are different types. I'll go one after the other. Number one is equipment leasing companies. So name itself is saying they will lease, they'll give money to get equipments and on leasing basis, on rental basis, you can say. Okay. Hire purchase finance companies, they provide loans for purchase of producer goods or consumer goods and services with no installment repayment system. Okay, leasing they give on rental, whereas hire purchase they have to pay in installments. Suppose they have taken 1 lakh, they have to pay in installments. Next is housing finance. So name itself is saying for the construction of houses, including getting the plots of lands or for construction of big houses, finance would be given. Next is investment companies. Then their aim is to acquire some securities. So acquisition of securities. So these companies, what they do, they are investment holding companies formed by business houses. Next is loan companies. So they give loans or they give advances to small concerns like wholesale and retailers. Okay, small scale industries, self-employed persons. They all need money, no? So loan companies are also there. Next, we have mutual benefit finance companies. We call specially it as Nidhi. Okay. What they do, they mobilize funds by share capital, deposits from their members, and from the public also, and they give these loans to their members, especially for marriages, redemption of old debts, construction, etc. Okay. Now, chit fund companies are also there. What they do, they collect subscriptions from public by way of periodical, monthly or quarterly, right? So they take subscriptions periodically, and then they lead them, and auctions would be there. Who gives a higher bid? No, that chit would be given to that particular person. Later on, they'll collect from the from that person. Apart from that, there are some categorization present. NBFS are seen. They are no accepting public deposits, so they are totally acting as a company now. They are accepting public deposits also, but they are not accepting public deposits, but engaged in loan investments, right? And hire purchase finance and equipment leasing. So when we have seen the types of these FCs, we have seen this, no, loan, hire purchase and equipment leasing. So they are working on this, but they don't accept from that. This type of NBCs. And NBC is not accepting public deposit and acquired shares and securities in their own group, in their holding group or subsidiary companies of and are not trading in their share securities. So these are the exception cases. Next is financial markets. We'll see the meaning of. See, financial market is the place. See, market itself we know buyers and sellers meet. Now here financial is the word used here. So it's a place where buyers and sellers of bills, commercial papers, bonds, shares, stocks, securities of different natures, okay, and maturity periods, including precious metals like gold and all, commodities, currencies, and derivatives. They are being bought and sold. So that's why we call it as a financial markets. Here not goods and services, but we are talking about all related with finance, all related with money, right? Those are brought and sold. So these instruments are traded normally at low transaction costs, at a very low rate. Next is money market institutions. So before that, we should know what are the functions of financial markets. See, I'll quickly go with this functions. Then I made a slide. Okay, I have. All right. Okay, then we'll move. Money market institutions, stock exchanges, they are important agencies that carry on these transactions in the financial market. So when you are talking about financial market, remember that money market institutions and stock exchanges, they play a vital role. When we look into the functions of financial market, one is, see, mobilize the dormant savings from the hands of larger number of savers and channelize them into the hands of needy investors. So getting savings, right? And then lending to whom? To the needy, right? One. Number two is provide an opportunity to lenders to earn either interest income or dividend income on their idle sources. See, uh, we keep money for ours as there's no use, right? Opportunity must be given so that no we can generate some more income, right, in the form. So they are giving a platform, so so that you can deposit, right? So an opportunity to lenders to earn either interest income or dividend. Number three is facilitate investors to mobilize funds on a large scale for investment easily, sometimes without the obligation of paying interest, but giving a share in profits in the form of dividends, right? Next is prices of stocks and securities traded in financial markets. They reflect the demand and supply conditions and hence provide valuable information about the past performance of business units and its financial soundness and solvency. So if we know the financial position of one business unit, how they were working, how the soundness of that business unit was, then we try to invest in that company if it is good, because we'll be getting more dividends. Right. Next is impart liquidity to the financial assets and the at the disposal of individuals and institutions, since they can easily be traded and converted into cash equally. So liquidity to convert cash to convert that security into cash very quickly. They facilitate capital formation, industrial development, and entrepreneurship development, and finally, economic growth and markets. See, what financial market is doing, we even know household or people of low income group also, they save some of the money and they try to have a bank account, and some savings they make, and that savings again are no in the form of credit is given to some needy. So things are happening no around the circle, the process is happening, savings and deposits and then lending and then investing, right? So then there's a possibility of economic growth, right, to larger extent, or giving loans to entrepreneurship or to for startups, and also hence economic growth would be there. So this is what financial markets are doing. Next, we'll see the classification of financial market. See, one is organized market and the other one is unorganized market. And then we have government securities and long-term loans market, including mortgages. So remember that there are four. One is organized market, unorganized market, government securities market, and long-term loans market. It includes mortgages also or mortgages also. See, organized market, it consists of commercial banks, cooperative banks, financial institutions, and development banks. So they are well organized. Okay, and again, this organized market, as I told you, we have money market and capital market. Money market, they transact in short-term assets, especially this, the maturity period would be 1 year. And the instruments these are traded in this market are commercial bills, bills of exchange, treasury bills, certificates of deposits, call money market, and some commercial papers. So they deal with these things. Capital market, little opposite of this money market, they deal with long-term instruments or with a period of more than 1 year. Okay, and what they are in what instruments they are dealing? Shares, stocks, bonds, securities. Okay, then this capital market again is classified into two, that is primary market and secondary market. So primary market, they trade in the issues of new companies. Secondary, they deal with already existing companies, shares and debentures. Okay. Unorganized market, they comprises of no large number of indigenous bankers, money lenders. You see, many of them. Even housewives, they give, somebody comes and put the gold with them and they just lend the money. Okay, these are all unorganized. Then we have government securities market. We call it as gilt edge securities also. They are which are issued in the form of bonds and credit notes. So they are trading related with the governments. Then we have long-term loans market. They are issued by the banks and financial institutions, including, as I told you, mortgages, pledges also you can say. Now, little further we go with money market. Money market, as I told you, it's a part and parcel of financial market, and they are dealing with short claims against money, right? Especially bills of exchange, treasury bills, commercial papers, and duration is for just 1 year, right? The term money market, many of them they have given, and according to Reserve Bank of India, it is this. See, the money market is the center for dealing in monetary assets of a short-term character. In the money market, the short-term surplus investable funds at the disposal of financial and other institutions and individuals are bid by borrowers comprising institutions and individuals and also by the government. Thus, it meets short-term requirements of borrowers and provides liquidity to lenders. So, simple terms, we can say it's a platform wherein short term wherein some financial instruments like bills of exchange, treasury bills, and commercial papers, they are traded and they are provided to uh, those who are in need, okay, for development. So simple, in simple words, we can say that.
Ma'am, I'm having a doubt here. Whether in this money market, is there included with the digital currency like cryptocurrency and everything, or else normally liquid cash?
Cryptocurrencies, no, these are now under the, we can say, they are looking after it, whether to bring it to RBI have to regulate this. So still,
How?
it's not a legal.
Okay, they are planning to combine the digital currency or the cryptocurrency.
Will you
It's in the
please put?
planning
Will
process.
you please? Uh, because see, at my end, where the sound is very low here. Will you please put that query in the chat box, Shravan?
Sure, sure, definitely.
Yeah, because no, see, voice is very low in my laptop.
No worries, no worries, ma'am.
Okay, by the time you type, I'll just
No, 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 I had
see.
done. I had
See
done.
if
I
you
had done.
understand. Okay, I'm asking whether the crypto or digital currency is included or still in the planning process. Yeah, what I said is yes, it is still in the planning process. They did not make it as a legal tender, RBI. Lot of
Okay.
things should be done to regulate that cryptocurrencies. Okay.
Sure, sure. Thank you for that, ma'am.
Yeah, yeah. Okay. So to understand it more further, money market, we can know the features of it also. We'll go little faster. Number one is, see, money market, as I told you, they transact not in money but only in near money assets. And the maturity period of this will not be more than 1 year. And this money market transactions, they take place between government agencies, commercial banks, and large corporate of reputed one. Okay. And these transactions are without any intermediaries, without any brokers. Okay. And presence of these financial houses like acceptance houses, discount houses, or guarantee houses, they are very essential for this developed money market. Okay. So some of these. Now let us see some of the instruments of money market. Can we take up in 7 minutes? See. Yeah. Number one is bills of exchange or commercial bills. These are bills which are generally taken or from trade domestics as well as international. A bill of exchange, if you have done your FA and all in your first undergraduate semester, bill of exchange you have to do, isn't it? It's a bill which is drawn by one party called as drawer to another party called drawee, isn't it? To repay that amount, specified amount, either on demand or on a specified date, isn't it? So these bills are normally for a maturity period of 91 days. Okay. Plus a grace period of 3 days. Unfortunately, the market for bills of exchange is not as well developed as we have in uh, other countries. Okay. Next is treasury bills. Treasury bills and ad hoc treasury bills are drawn by the central and state governments and discount them with commercial banks or financial institutions. See, treasury bills always will be with the government. Okay. They'll be dealing with this, commercial banks and financial institutions, and they also have some specific maturity duration, that is again 91 days and 182 days or 364 days. So in these categories they have divided, and they are also called as maturing papers, as they can be liquidated very quickly. They are very less risky investments, we can say, because no, they are issued by government, right? They say no, 1 rupee from the government also, it will not be a loss, you will get it. Even the government changes also, they'll get it. So when treasury bills are being dealt by the government, so there's no risk at all in this investment. Next is certificates of deposit. Certificates deposit is like a bank deposit receipt issued to the bearer to receive interest. Okay, certificate of deposit, they clearly specify the date and the amount to be repaid. And normally, this maturity period, it is between 3 months to 5 years. Okay, the investors in these certificates of deposits, they receive higher yield compared to bills of exchange and treasury bills, but they are very risky. Okay, and sometimes they prone to for default. You may lose whatever you have invested. Next is commercial papers. Commercial papers are low cost alternative to investors and traders to mobilize funds, especially in lieu of loans on the security of their receivables or inventories, stocks and all. They have a maturity period between 1 day to 270 days. And this can be discounted through money market financial institution. They are also very risky. Certificate of deposits and commercial papers, they are very risky. Next, we have repurchase agreements. Yeah. These are the agreements now which tells the banks to sell or borrow from RBI or other banks. So repurchase agreement, right? These agreements are sold by the sellers within promise to pay them back at a given price and a specified time frame. Similarly, a buyer can also purchase them to sell them back to the seller. So buyer can become a seller, seller can become a buyer. So repurchase agreements can be done. It is these instruments through which repos and reverse repos of the RBI influence, especially the availability of credit. Okay. In simple terms, we can say when banks, they are borrowing from RBI, they have to pay back in repo rate of interest. And if they keep this idle cash with RBI, they have to get reverse repo rates. So, and presently, the difference between repo and reverse repo, it can be between 1.4% to 0.5%. Next, we have bankers' acceptances. A banker's acceptance, where it's a short-term debt instrument. They are issued by the company, and that is guaranteed by commercial bank. So in case if they pay, commercial bank would pay. They are similar to treasury bills, and they are traded in the money market. They can be discounted at the face value in the secondary market also. And bankers' acceptance, they vary based on the amount negotiable instrument like bills of exchange and commercial bills. Okay, so that's all about money market. Now we have capital market. See, according to Herbert E. Doggle, capital markets are complex institutions or complex of institutions and mechanisms whereby intermediate term funds, loans up to 10 years maturity, and long-term funds, longer maturity loans, and corporate stocks pooled and made available to business, government, and individuals, and where instruments that are already outstanding are transferred. So, in simple terms, okay, don't be getting confused and all. In simple words, it's a market for long-term funds, and it is providing resources needed by medium scale industry and large scale industry. For what? For investment purposes. So it deals with funds with more than 1 year maturity. If you remember these three features, it's all about money market. Okay. The structure. Uh, Before that, you should know the importance of capital market also before we move to structure of Indian market. Right? See, capital market, they are providing capital. So capital formation is there, industrial growth would be there, and economic growth would be there because of capital. Because huge funds, infrastructure would develop, right? Then economic growth would be. And it is providing to medium and long-term industries so that no, they can have fixed assets or fixed capital and all, right? Capital needs can be fulfilled. Number three is it is offering or giving us an opportunity even to small savers to become partners and owners of the company. So if you are taking, if the company is issuing 10 rupees share and if you are buying, you become the owner of the company. So that opportunity